You are sitting at your kitchen table. It is January 2026. You just opened your new Medicare premium statement, expecting the standard $202.90 a month. Instead, the bill says you owe nearly $700 every single month. Your heart drops. You didn't get a new job. You didn't win the lottery. You didn't sell a house. But 2 years ago, you sat across from a mainstream financial advisor who smiled and told you to do a big Roth conversion to save on taxes. And in doing that, you crossed an invisible IRS tripwire by exactly $1. And the federal government just quietly confiscated your Social Security raise to pay for it. This is the IRMAA cliff. It is a delayed detonation, and it is wired to go off 2 years after you pull the trigger. By the end of this video, you will know the exact dollar limits, the exact timeline, and the exact move the wealthy use to walk right up to the edge without falling off. The suits want me to tell you this is not financial advice. Fine. It is a survival manual for an unguarded vault. So let's start with the lie everyone is repeating right now. Every advisor, every late-night radio show, every glossy newsletter is screaming the same thing in 2026. Convert your traditional IRA to a Roth while the One Big Beautiful Bill Act senior deductions are still active. And on the surface, that advice isn't insane. Roth money grows tax-free, comes out tax-free, and never forces you into required distributions. But here's the part they conveniently leave out. The IRS and CMS, the Centers for Medicare and Medicaid Services, do not operate on the same clock. They operate on a delayed 2-year timeline, and that delay is not an accident. It is designed to obscure the damage. You make the decision today, in 2024. You pay the income tax today. And then, 2 years later, the bill for a second penalty shows up in your mailbox, completely disconnected from the choice that caused it. That penalty has a name: IRMAA, the Income-Related Monthly Adjustment Amount. It is a hidden wealth tax on the middle class, dressed up in bureaucratic language so boring your eyes glaze over before you understand what it's doing to your money. And here is the single most important thing you will hear today. IRMAA is not a gradual phase-out. It is not a slope. It is a cliff. A brutal, merciless, all-or-nothing cliff. $1 over the line and the full surcharge detonates. Now, before I show you exactly how this destroyed a retired couple last year, smash the like button right now. Do it as a direct act of rebellion against an algorithm that hides this math from the seniors who need it most. Because they would love nothing more than for this video to die in silence. Let me take you to the crime scene. Meet Arthur and Peggy. They're 71 years old. They did everything right their whole lives. Between Arthur's pension and their combined Social Security, they pull in $180,000 a year. Comfortable, careful, not rich. In 2024, they sit down with their advisor, and he tells them to convert $40,000 from their traditional IRA into a Roth. Protect your legacy, he says. Lock in today's tax rates, he says. So they do it. Now watch the dirty math. You take their $180,000 of income. You had the $40,000 Roth conversion, which the IRS counts as ordinary income. And their modified adjusted gross income, their MAGI, lands at $220,001. Remember that number. Now, here is the 2026 IRMAA threshold for a married couple filing jointly. $220,000. They went over the edge by exactly $1. $1. Not 10,000, not 100. One single dollar pushed them over the cliff. And because IRMAA is all or nothing, that $1 triggered the full surcharge on both their Medicare Part B and their Part D premiums. The extra cost for that $1 mistake? Over $4,500 for the year. If Arthur had converted just $1 less, that penalty would not exist. The extraction engine is that precise. And here's the cruelest part of the design. The money to pay that surcharge gets pulled directly out of their Social Security check, the very COLA raise they were counting on to fight inflation. The government gives you a raise with one hand and confiscates it with the other. Now, some of you are already thinking, well, this depends on where you live, right? Yes and no. And the difference is going to make your blood boil. Because while IRMAA is a federal trap that hits everyone the same, the Roth conversion itself gets taxed differently depending on your state. So Arthur and Peggy don't just bleed once. In some states, they bleed twice. Let's run their exact $40,000 conversion through 3 states. Start with California. In California, that conversion is taxed as ordinary income at a top rate that climbs all the way to 13.3%. So Arthur and Peggy hand a massive chunk to Sacramento on the conversion, and they still walk straight into the federal IRMAA cliff. 2 wounds, same day. The state takes its pound of flesh going in, and CMS is waiting at the bottom of the cliff to take the rest. Now slow it down and move to Ohio. In Ohio, the state income tax bite on that conversion is far gentler, around 3.5%. So they keep more of their money on the way in. They're better off than the Californians, but better off is not safe. Because the IRMAA cliff is federal. Ohio cannot save you from CMS. They're still standing in the exact same crosshairs. And then there's Florida. 0 state income tax, the retiree's dream. The conversion itself cost them nothing at the state level. And yet, the federal IRMAA cliff still detonates on schedule. That's the lesson nobody tells you. You can run to a no-tax state and still get gutted by a Medicare surcharge 2 years later. Geography is a shield against your state. It is not a shield against the federal extraction engine. So let me ask you something, and I want a real answer in the comments. Have you ever opened a Medicare statement and found a surcharge you didn't see coming? Tell me your field report below. Drop the state you're in and what it cost you, because every comment helps another retiree spot the tripwire before they hit it. Now, if your stomach is in a knot right now, I get it. That anxiety you're feeling is the appropriate response to discovering the floor has a hole in it. If you want to map your own exposure before you make a single move this year, I put together a free estate risk assessment over at retireeshieldreport.com. It walks you through exactly where your income lands relative to these cliffs. Go grab it, then come right back, because now I'm going to show you the part the suits never will. How the wealthy walk up to this exact cliff and never fall. Here is the dirty secret. The rich do not avoid Roth conversions. They just never do them the dumb way. They never do a lump sum. A lump sum is for people who don't understand the cliff. Instead, they use a strategy called bracket filling. They calculate the exact distance between their income and the next IRMAA threshold, and they convert only up to that line, not a dollar over. Watch what that does for Arthur and Peggy. Instead of converting the full $40,000 in 1 year and blowing past $220,000, they split it. They convert a smaller slice this year, staying safely under the cliff. Another slice next year, the rest the year after. Same total conversion, same legacy protection, 0 IRMAA penalty. This is called income smoothing, and it is the single most ignored tool in retirement planning. But the elite go one layer deeper, because the smartest move is to pass wealth without spiking your MAGI at all. A properly structured life insurance policy lets you transfer money to your heirs completely tax-free, and it never shows up on the income line that triggers IRMAA. Same with a properly structured irrevocable trust. You move assets out of your taxable estate, you protect the legacy, and you keep your reported income below the cliff at the same time. This is the elite solution, and traditional advisors ignore it for one ugly reason. There's no assets under management fee in it for them. They get paid a percentage to keep your money in their accounts. Moving it into a trust or an insurance structure shrinks their paycheck, so it quietly never gets mentioned. Now, what if it's too late? What if you already got hit? There is an appeal process. It's called Form SSA 44. If you had a genuine life-changing event, retirement, the death of a spouse, a divorce, a loss of income, you can file that form and ask CMS to recalculate based on your real situation. But here is the warning that will save you a heartbreak. A voluntary Roth conversion does not qualify as a life-changing event. You chose to do it. So in the eyes of CMS, you chose the penalty. There is no appeal for a self-inflicted wound, which is exactly why the defense has to happen before you pull the trigger, not after. So step back and look at the whole machine. The IRS waves you toward the Roth conversion and collects the income tax up front. Then it whispers your new income number over to CMS. And 2 years later, while you've completely forgotten about that 2024 decision, Medicare reaches into your Social Security check and takes the surcharge. The system is not broken. The system is working exactly as designed. It runs on your confusion. It runs on the fact that almost no one connects a financial decision in 1 year to a premium spike 2 years down the road. That 2-year gap isn't a bureaucratic accident. It's the camouflage. But you're not confused anymore. You know it's a cliff, not a slope. You know it's $1, not 10,000. You know geography won't save you, and you know the bracket-filling move that walks the line without crossing it. You don't have to be Arthur and Peggy. If you are planning any major financial move this year, a conversion, a big distribution, the sale of an asset, go to retireeshieldreport.com right now and grab the 2026 Retiree Asset Protection Blueprint. Stop guessing where the tripwires are and start building the fortress around them. And share this video with one person you care about today. Not tomorrow, today. Because the cliff is silent, and the only warning they'll ever get is you. This is the Retirement Insurgent. This is the archive. I'll see you in the next one. Protect the vault.